In the lexicon of the stock market, few words hold as much promise and peril as the breakout. It is the moment a stock, after a long period of quiet consolidation, suddenly bursts forth, shattering the boundaries of its previous trading range. To the hopeful eyes of the trading public, this is a signal of immense opportunity, a clarion call to action, the beginning of a swift and profitable move. Yet, for every true breakout that launches a glorious new trend, there are a dozen imposters, false moves, or fakeouts that lure in the unwary only to reverse with brutal speed, leaving a trail of financial devastation in their wake. The great challenge for any speculator is to distinguish the genuine from the fraudulent. Jesse Livermore, the master speculator, understood this challenge more profoundly than any of his contemporaries. He knew that the vast majority of traders fail precisely at this juncture. They are driven by an eagerness to be the first, to catch the very beginning of the move, and in their haste, they mistake a flicker of activity for a true conflagration. They jump into a position based on a single candle, a fleeting moment of strength without waiting for the market's own deliberate, considered confirmation. This, Livermore learned, was not speculation. It was a blind gamble. And it was a gamble the market would punish with ruthless efficiency. His entire method was designed to solve this one critical problem: how to recognize a strong, legitimate breakout and avoid the costly traps of a false one. He did not seek to be the first man in. He sought to be the right man in. His approach was not based on guesswork or instinct alone, but on a scientific, methodical interpretation of the market's own behavior. He let the tape tell him the story, and he did not act until that story was clear, unambiguous, and confirmed by a series of logical, sequential tests. He knew that the real money was made not in the initial jump, but in the sustained, powerful trend that followed a genuine breakout. For those who are committed to a deeper, more methodical study of the principles that governed Livermore's legendary career, the essential text remains Edwin Lefebvre's 1923 masterpiece, Reminiscences of a Stock Operator. It is a book that transcends time, offering profound insights into the unchanging nature of markets and men. We highly recommend the edition that features a unique, detailed chapter-by-chapter analysis by Max Davidson, an interpretation specifically designed to translate this century-old wisdom for the modern reader, making its lessons more powerful and accessible than ever before. A link to this essential edition has been provided for you in the description below. The foundation of Livermore's breakout strategy was his concept of pivotal points. He was not interested in every minor level of support or resistance. He focused only on the truly significant price levels, the major strategic battlegrounds, where the long-term fate of a stock's trend would be decided. A pivotal point could be a stock's all-time high, the peak of a previous major swing, or the upper boundary of a long and well-defined consolidation range. It was at these critical junctures that he would watch with the intensity of a hawk. He understood that a move through a pivotal point was not in itself the final signal. It was merely the initial alert, the first sign that a major change could be underway. The true test, the thing that separated a real breakout from a false one, was what happened after the break. Did the stock follow through with power and conviction? Or did it falter, hesitate, and retreat? The character of the price action immediately following the breach of a pivotal point was everything. This led him to develop a series of mechanical, unemotional rules for confirming the validity of a move. After a stock broke through a pivotal point, it had to demonstrate what he called a proper continuation. It could not just limp across the line. It had to surge through it. To provide a concrete mathematical measure for this, he established his famous 3-6-point rule. For an individual stock, a breakout was not considered confirmed until the price had advanced at least 3 full points in the direction of the break. For his composite key price of market leaders, the required move was 6 points. Anything less than this was a danger signal. If a stock broke its pivotal point by a point or two and then immediately fell back, it was a classic false move, a trap for the impatient. Livermore would not only refrain from buying such a stock, but he would often take it as a signal to go short. recognizing the move as a sign of weakness and distribution, not of strength and accumulation. This simple numerical rule acted as a filter, protecting him from the market's most common deceptions. Another critical element of a true breakout was the behavior of the stock during its first natural reaction after the initial move. No trend moves in a straight line. After a strong initial surge, a period of pullback and consolidation is normal and healthy. Livermore would watch this reaction with intense focus. A genuine breakout would be followed by a reaction on significantly lighter volume than the advance that preceded it. This indicated that the selling pressure was light and that holders of the stock were not eager to part with their shares. The ultimate confirmation came after this reaction had run its course. A strong stock in a true new trend would quickly recover from this pullback and then surge forward again, pushing into new high territory with renewed vigor. This pattern, breakout on heavy volume, natural reaction on light volume, followed by a new advance to a new high, was the unmistakable signature of a legitimate, powerful trend. It was the market's own declaration that the line of least resistance was now decisively upward. Conversely, the signs of a false breakout were equally clear. If, after breaking a pivotal point, the stock experienced a sharp and severe reaction on heavy volume, it was a warning. If it then failed to rally with any conviction, or if its rally was weak and petered out below the old high, the breakout was a fraud. It showed that the initial buying power was a temporary anomaly, not the beginning of a sustained campaign. The inability of the price to recover and push forward was a definitive signal that the move had failed. Volume was another critical diagnostic tool in his arsenal. A breakout that occurs on a sudden, dramatic increase in trading activity is far more significant than one that happens on a quiet, low-volume day. High volume indicates that a major shift in ownership is taking place. It shows that there is a powerful, aggressive buying interest that is willing and able to absorb all the stock that is being offered at the old resistance level. It is evidence of a real and significant demand. A breakout on low volume, in contrast, is often suspect. It suggests a lack of conviction and can easily be reversed. The character of the follow-through was paramount. A strong breakout should not look back. The stock should move away from its old consolidation range and show no inclination to return. If a stock breaks out to a new high and then, within a day or two, plunges right back into the middle of its old range, it is a sign of profound weakness. It indicates that the breakout was not driven by genuine accumulation, but was perhaps a manipulative move designed to catch stops or distribute stock to an unsuspecting public. The inability of the price to hold its new ground is a clear signal to stay away. Finally, any legitimate breakout must be in harmony with the market's overall line of least resistance. A single stock attempting a major breakout while the general market is weak and trending downward is fighting an uphill battle. While it can happen, it is an exception, not the rule. Livermore always preferred to trade with the prevailing current. He sought to identify the leading groups in a bull market and then focus on the strongest stocks within those groups. A breakout is infinitely more likely to succeed if it is supported by a bullish tide in the overall market and its specific industry group. His legendary trades were a testament to these principles in action. Consider his campaign in Anaconda. He did not buy it because he liked the copper business or because of a rumor. He bought it for one reason. It had broken its pivotal point at $100. He recounted how the instant it sold at that price, he placed his order. The stock did not hesitate. It surged forward, climbing to 115 in a matter of days, confirming the breakout with a powerful, sustained advance. He repeated the exact same maneuver when it crossed the $200 pivotal point, capturing another massive gain. It was a perfect illustration of his method. Wait for the signal, confirm the follow-through, and ride the trend. His operations in U.S. Steel told a similar story. He began accumulating his massive 72,000 share line because, from the very start, the stock acted right. It was a leader, its movements were strong and decisive, and every purchase he made was met with higher prices. The breakout was not a single event, but a continuous process of the stock proving its own strength, a process that allowed him to build his position with confidence. The true breakout in this sense was a sustained condition, not a momentary price spike. The journey of a speculator is often a solitary one, marked by the intense pressure of making high-stakes decisions alone. It is easy to lose perspective, to be swayed by the noise of the crowd, or to falter in your discipline after a series of setbacks. This is why we created this channel, to serve as a constant source of these timeless principles, a place you can return to, not just to learn, but to recalibrate your mindset. If you are committed to the path of a professional speculator, subscribe to our channel and return to these lessons. They are here to provide not just knowledge, but reinforcement and perspective when you need it most. Furthermore, we recognize that the wisdom of the markets is not a monolithic doctrine, confined to a single individual. Jesse Livermore was a titan of the tape, a master of timing and psychology. Yet, the history of Wall Street is a pantheon of geniuses, each with a unique approach. Consider the fundamental power of a man like J.P. Morgan, who did not merely trade the markets but at times was the market, a stabilizer of panics whose influence was built on capital and control. Contrast this with a master like Nicholas Darvas, who decades later proved the timelessness of trends by developing his box theory, a brilliant mechanical system for identifying breakouts. The field is rich with other legends: the mathematical precision of Gann, the volume analysis of Wyckoff, the deep economic insight of Baruch. To explore this rich history of market genius, we have recently launched a new channel dedicated to studying the diverse strategies of the world's greatest traders and investors. If you wish to broaden your understanding and learn from a multitude of different styles, the link to this new channel is in the description below. Join us there as we continue to uncover the timeless secrets of Wall Street. Perhaps the most powerful application of his breakout principle came in reverse during his masterful anticipation of the 1916 bear market. He was not looking for a single stock to break down, but for the entire market structure to crack. The signal came when he observed that the great leaders of the preceding bull market, stocks like U.S. Steel and Anaconda, had stopped advancing. They would have reactions, but they would not rally back to new highs. This failure to continue the trend was, for him, a breakout signal of the highest order, a breakout into a new bearish phase for those specific stocks. While the rest of the market was still buoyant, the generals had fallen, and he knew the army would soon follow. This was the ultimate confirmation, a sign that the great bull tide was finally turning. For Livermore, a strong breakout was never a single isolated event. It was not a mere candle closing above a line on a chart. It was a confirmed, validated movement, a symphony of signals playing in harmony. It was a breach of a major pivotal point, accompanied by a surge in volume, followed by a powerful and sustained continuation of the move. It was confirmed by a shallow, low-volume reaction, and reconfirmed by a swift rally into new high ground. And above all, it was a movement that was aligned with the market's overall line of least resistance. His method was a filtration system, meticulously designed to separate the high-probability trades from the low-probability gambles. It was a defense against his own impatience, a bulwark against the siren song of false moves. He understood that the cost of missing a few points at the beginning of a move was insignificant compared to the cost of being drawn into a false one. The speculator's job is not to be a hero who catches the absolute bottom or top, but a professional who enters a trade only when the odds are overwhelmingly in his favor. Ultimately, the truest test of a breakout is the one that appears on your brokerage statement. A genuine breakout, entered at the correct psychological moment, should show you a profit almost immediately. It feels right. The market is flowing with you, not against you. A false breakout, in contrast, feels like a struggle from the very beginning. It does not move as it should. It hesitates, it falters, and it quickly begins to eat away at your capital. This, Livermore would say, is the tape's final, irrefutable verdict. Even with all these signals aligned, he never abandoned his core principle of prudent risk management. He never charged into a breakout with his entire line at once. He would first buy a small portion to test the move. If it acted as it should and showed him a profit, he would add another portion, always at a higher price. He scaled into his position, allowing the market's own confirmation to justify his increasing commitment. This ensured that his largest bets were always placed on what was already a winning trade. This combination of patient observation, mechanical confirmation, and disciplined execution was the true source of his genius. It was how he recognized and profited from the great trends of his time.